In a fight between the Federal Reserve and the federal government, which one do you think would win?
Who will win? I don't know yet.
Now, this question might seem preposterous at first because you'd think that those two entities, the money printer and the money spender, would never be at odds with each other. But in fact, that's the exact situation we find ourselves in today. The Federal Reserve, on one hand, is trying to combat inflation. They're doing this by letting assets bleed off of their balance sheet. They're also doing this by raising interest rates. On the other hand, the federal government is throwing fuel on the inflation fire by increasing its deficits and borrowing exponentially. And there's a term for this, which you will probably start hearing more and more over the next 6 months to 1 year. In the case where the federal government's spending and deficits and borrowing are so large that it overcompensates for any tightening efforts that the Fed does. This term is called fiscal dominance. So let me first explain the term. Monetary policy and fiscal policy are two separate things. Monetary policy is stuff done to the money. It's trying to increase the money supply or decrease the money supply, and that is the realm of the Federal Reserve. This is done through, like we looked at earlier, raising or lowering interest rates or increasing or shrinking their balance sheet. So everything the Fed does is monetary policy. On the other hand, fiscal policy is anything the government does. So this is taking money through taxes, this is borrowing money through debt issuance, treasury issuance, and it's spending money wherever they decide to spend the money. Those three things are fiscal policy. Currently, these things are at odds with each other, and in the case where fiscal policy overtakes and has a stronger influence on the economy than monetary policy, that is called fiscal dominance. This is an article published on the Federal Reserve's economic research page, and it highlights that fiscal dominance is the possibility that the accumulation of government debt and continuing deficits can produce increases in inflation that dominate central bank intentions to keep inflation low. So I'm going to explain how this works, but it's important to understand that the general assumption here is that there is going to be some sort of pivot, because if monetary policy stays strong and continues on the path, it does have the strength to overpower fiscal policy. The only way we end up in a fiscal dominance situation is if monetary policy voluntarily gives up its position. In other words, if the Federal Reserve surrenders. First, we have to take a look at this quote from the United States government itself that came in February of 2023. Under current policy, the debt to GDP will reach 566% by 2097. This projected continuous rise of debt to GDP indicates that the current policy is unsustainable. Basically, the government is borrowing at a much faster pace than GDP is growing by. And we can break down what the government is spending its money on in three main categories. Category number one is mandatory expenses. So these are things the government has to spend all the money on as required by law. Now, they can always change these laws, but that's very difficult to do. The second category is discretionary spending. So money left over, they get to spend in these discretionary categories, and typically these are going to be the easiest to slash if there's not enough money. But the third category that I do believe belongs in a category all by itself is interest on the debt. As you can see from this hockey stick shaped chart, the interest on the national debt is increasing extremely rapidly. It has recently approached $1 trillion, and by the end of 2024, it'll be about $1.2 trillion. This is because every time old debt matures, when the government has to pay off that old debt, whether that was a 1-month treasury bill or whether that was a 30-year treasury bond, in order to pay that off, they have to borrow new debt in order to pay off that old debt. But that old debt was borrowed when interest rates were 0, 1, 2, 3%, and the new debt is being borrowed at multi-decade highs in excess of 5%. And so going back to the three categories of spending that the US government has, where they have discretionary spending, mandatory spending, and interest expenses on the national debt, we have two categories that are destined to grow no matter what. mandatory spending for things like Social Security and Medicare, and the interest on the national debt. And because these are being funded by borrowing more and more, this is like a snake eating itself by the tail. The amount the government has to borrow to pay for all of its expenses must grow every single year because the economy is not growing fast enough to be able to tax it directly to pay for these things. And every year this situation gets worse and worse. This is why under the rosiest of circumstances, the federal government itself expects that the debt to GDP will reach 200% within the next only 30 years. And that's not factoring in any recessions, any drop in tax revenue, or any other unexpected expenses, or paying for a much more expensive interest load on the national debt. But first, a word from today's sponsor, I Trust Capital. Investors today face all sorts of new and unique risks. Invest in stocks and risk a stock market crash. Invest in bonds and watch the value of those bonds drop as interest rates rise. Keep your money in cash and watch inflation eat away your purchasing power. Invest in crypto and watch frauds like Sam Bankman-Fried steal all your money. This has many investors looking to alternative stores of value like gold and Bitcoin. The problem with this is that most investors are not able to access gold and Bitcoin. This is because most people have most of their assets tied up in their retirement accounts. And most retirement accounts do not allow you access to things like gold or silver or Bitcoin. This is where I Trust Capital comes in. I Trust Capital allows you to open up a new retirement account or even transfer an existing retirement account. Then you can purchase alternative stores of value with your retirement like gold, silver, and Bitcoin. In days like this where fraudulent platforms like FTX are collapsing and traditional banks like Silicon Valley Bank are failing from bank runs, I Trust Capital is still going strong because they do things the right way. You own your assets there. Your assets are always held off balance sheet and your accounts are never commingled with theirs. They partner with industry leaders like Kitco for their precious metals. They are straightforward about how they keep your assets separate and safe. And if you use my link in the description below, you will get $100 worth of Bitcoin just for signing up. Now, at some point before we get there, because it can't last that long, there will be something that happens. And basically this will be the government tries to borrow money and can't. This would look like the government trying to borrow through issuing a bond auction and the auction failing, in the sense that the interest rate that would be required by the market on that new bond offering is so high that the government withdraws the offering. Now, if you are reading ahead, you noticed that the end of that sentence is that the government turns to money printing as its alternative. But here's the issue. The federal government doesn't control the money printer. The Federal Reserve does. This is important to understand because everything that happens up until that point, where the government can no longer borrow from the economy and then instead tries to look towards the printer, all of that is actually deflationary. This is money getting sucked out of circulation from more productive members of society who are using that to create wealth, and it gets transferred instead to the government, who at best is going to use it for something that is less productive, but more likely use it for something that has a net destructive effect on wealth. Now, the Federal Reserve is fully aware that the government is currently in an unsustainable fiscal situation. In fact, just recently, Powell was speaking about this fiscal situation being unsustainable. And this is likely why the Federal Reserve decided to hold rates steady recently, because the government is borrowing so much that they're pushing interest rates up all by themselves. The Fed no longer needs to push up the short end of the curve because the federal government's additional borrowing is causing them to have to borrow at higher and higher rates to attract enough money to be able to borrow. But once we get to this point where the government tries to borrow money and they can't, make no mistake, they will turn to the money printer. This would be a return of QE, quantitative easing, where the Federal Reserve purchases US government debt. Now, that's not actually as simple as it sounds because number one, if inflation is still around, the Federal Reserve will probably not want to do this. Powell has said explicitly in the past that they will not even consider, under any circumstances, helping the government out of their own fiscal situation. That's not what the Federal Reserve is for, and it is not even allowed legally under the Federal Reserve Act. However, if inflation is completely gone at that point and well under the target 2%, they may be able to get away with it. So what do you think would happen if inflation is still here and the Federal Reserve refuses to return to QE. One of two things would happen at that point. Option number one would be that Congress would immediately rewrite the Federal Reserve Act. The Federal Reserve would no longer be there in order to keep prices stable or to keep employment at a maximum level. Their primary mandate at that point would then be to provide the funding necessary to the US government. And under the coercion of that new law, the Federal Reserve would submit and they would print the money necessary to buy the treasuries necessary to provide the funding for the US government that they need. The alternative would be folding the Federal Reserve underneath the Treasury so that the Treasury assumes those responsibilities instead of a private, semi-private entity with political independence, the Federal Reserve. Either one of these outcomes is essentially the government taking control of the money printer, and it's no longer debt, but it's inflationary financing. Now, what is the likelihood of this happening versus the alternative? Well, consider what the alternative is. The alternative to the government getting the money printer to finance its inescapable debt spiral is actually default. It is the government not being able to pay back its debt. It is a deflationary death spiral, a dethroning of the US dollar. It is absolute chaos. And you may think that that's a better outcome because of the way that your portfolio is positioned, and you could be absolutely correct. However, the US government will definitely not agree with you. And if they're sitting there faced with the choice of defaulting on the national debt and a deflationary death spiral and a dethroning of the dollar as the global reserve currency, and the alternative is take over the money printer, that is absolutely what they're going to do. Yes, it will reignite inflation, but that's a longer term pain for somebody else down the road to deal with the consequences of. It's a problem for future me. And that is the choice that politicians choose every time if they can. So the question of who will win between the Federal Reserve and the federal government, when push comes to shove, it's the government every time. And if you're sitting there thinking, man, this is overwhelming, how in the world is anybody supposed to make money investing? Because you do the same thing that people have said to do, the traditional advice, and it looks like that kind of portfolio is doomed for failure. But if you try and go out on your own and make your own trades, every time you make a trade, you lose. You look for trends and you end up buying at the top and selling at the bottom. That's exactly why I created Heresy Financial University. It's a membership program that gives you access, unlimited access to the entire training library of financial education that will give you everything you need to know to be able to understand how markets work and make money investing. I have hundreds of members who have been paying me every single month to continue being members because they're continuing to learn more and more from the new lessons and new courses that I load up into the membership program. And I also have a few hundred new members that have just joined recently. And one thing that they've been telling me is that they didn't realize how much was on the other side there, because I guess I haven't been explaining in detail on my videos. So I wanted to take an opportunity here to let you know what is available, just in case you're sitting there wondering if it's something that's for you. You get unlimited access to every single course that I currently have for sale that are all included automatically with the membership. Each one of these courses has dozens of lessons that I've put hours into creating, very extremely easy to understand lessons on how the market works in that particular area, like portfolio allocation or fundamental analysis, and then giving you the tools and the steps and the systems you need to actually make money with it. Whether you're getting out of debt, wanting to know how to maximize the return on your savings without making your cash, increasing the risk on your cash, allocating your portfolio in a way where you can make money during deflationary times or inflationary times. Advanced option strategies, including tail hedging, iron condors, butterfly spreads, and you automatically get access to every new lesson and new course that I put in there as well. We also do a monthly members only live stream. This way, if there are any questions that you come across during the lessons, then you have a chance to ask those directly to me during a live stream. And if you're not able to attend live, you're able to access all past recordings as well. I've been receiving tons of great feedback from new members recently, saying things like, from Jeff, he said, "I'm really enjoying your classes. Thank you for the great stuff." David said, "Really enjoying the membership so far. Wish you the best." Adam said, "Excellent series, very well put together. Glad to have stumbled upon you and your work," and many more. The price is $99 per month. I'm going to be adding many more courses and lessons between now and the end of 2024. Your price, once you become a member, is locked in forever. But because of the things that I'm adding over the next 2 months, starting in January, I'm increasing the price. The price will never go back down again. New members will have to pay that new higher price. But existing members, anybody who has already signed up or who signs up now between the end of the year, will be locked into the current pricing of $99 a month. And yes, the money that you're going to be able to make from increasing your returns and reducing your losses, investing according to the steps and the tools that I give you in these courses, you're going to make a lot more than that, which means the sooner you get started, the sooner you're going to start making more money investing. Link is below. As always, thanks so much for watching. Have a great day.